Good afternoon to all the attendees of Insight 2020. I'm Rachel Wee, the Vice President of Sales here at Smartkarma. It's my pleasure today to introduce our next presenter, Munib Madni, who is the founding Panvestor and CEO of Panarchy Partners. So Munib has had an illustrious career in investing spanning over the last 25 years. He started his career as a junior fixed interest portfolio manager in 1994 and then moved on as an equity investor and PM from 1996. Including stints at equity-linked investment management at Aberdeen. His last 13 plus years were spent at Morgan Stanley Investment Management in multiple roles, including the PM Emerging Markets team, co-PM Active International Allocation Strategy, and as the Chief Investment Officer in Asia. While he was the CEO at MSIM, Munib was involved in integrating ESG into MSIM's investment processes. So this process was what led to his conviction and decision to have sustainability redefined and incorporated at the core of the investment process. So we'll be presenting today, and then we're going to leave some time at the end, hopefully for some audience Q&A. So post your questions using the Q&A function at the bottom. And so without further ado, I'll let Munib take it away from here.
Thanks, Rachel, and hi, everyone. Yes, I have been an investor for more than a quarter of a century, and I'm looking forward to the next 25 years or so. So as Rachel mentioned, I left traditional investing when I left Morgan Stanley in 2018, and we set up Panarchy Partners. And at Panarchy Partners, we believe that there's a slow, subtle, but a significant shift in capitalism. Capitalism as what we all grew up with and what we studied, which also had shareholders and corporations and risk and return at its core. With financial capital, the main focus is and has been evolving. And now it's moving towards a lot more inclusive form of capitalism, which can be called stakeholder capitalism. And as this evolution is occurring, I think we also need to be mindful as investors that investing also needs to evolve. And today, what I intend to do and share with you guys is how we at Panarchy Partners believe that this next evolution in investing to incorporate stakeholder capitalism or to adjust for stakeholder capitalism is called Panvesting. And again, today I will share with you how investing has evolved over the centuries, leading up to where we are now, and why we believe that Panvesting is the way to go going forward. So today, as I said, I'm going to take you on a bit of an evolution of investing, and to help me time travel from the past till now and beyond. So as to understand this evolution of investing, I'm going to use a two-dimensional graph as a tool. So first, on the x-axis, I have the distribution of wealth or financial capital from the few to the many over time. Then on the y-axis, I have put the three other forms of capital, which is human, social, and environmental. And these forms of capital are also needed for wealth creation. The y-axis also shows the level of respect shown to them from low to high, and that's how sustainable they are. Now, with these two axes in place, over time, we have seen that wealth being distributed from a few to the many, and also some improvements in respect for other forms of capital as shown in this line. However, we have now reached a plateau in terms of sustainability and respect of these other forms of capital, which will become even more obvious as I take you on this quick history tour. So just imagine yourself to be a time traveler, and you're back in 1100 AD and before. So this was a time of the first female pharaoh, Hatshepsut. She was arguably the first billionaire, would you believe it? And we have King Solomon, the first philanthropist. We had Cleopatra. We had other conquerors and kings such as Empress Wu and William the Conqueror. This was a period where conquest by kings or connection with kings made you rich, with a little regard for human, social, or environmental issues. The next phase that we go into is 1100 to 1600 AD. Kings and conquerors such as Genghis Khan were joined by explorers like Marco Polo, bankers like Medici and Jacob Fugger, and even traders of commodities saw wealth creation. Elites in trade finance, and art started to emerge among the wealthy. Finance was just getting started with banks, bonds, and even the Holy Roman Emperor Charles V had his own annuities. This was when we saw Magna Carta Libertatum, the Great Charter of Liberties, one of the first modern legal social contracts signed. We also saw Francesco Petrarca, the first humanist, arguably start the Renaissance. By 1516, we actually had Thomas More's Utopia was also published, which is seen as one of the first communist manifestos. So social contracts were improving. The world's population at this point was 1,500, at 1599 was roughly 600 million. Environment was damaged by natural disasters, but not by investors or by humans themselves. This leads us to 1600 to 1900 AD, one of my favorite periods. Interesting, this period starts with when, for the first time, the word investor was used. And it was used thanks to the Dutch and the British East India companies introducing their stocks. Investing as we know it emerged as a new form of wealth creation, and financial capital was the main concern for these guys. Not surprising, it was soon followed by the first financial bubble, which was the tulip crisis of 1634. During this period, we had colonization was rampant and went unchecked globally. We saw increased wealth distribution, even if it was courtesy of this colonization. We saw improving social contracts, even if courtesy of revolutions, such as the US independence of 1776 and the French Revolution of 1789. So kings and queens, such as Charles I and Queen Marie Antoinette, were losing their heads as much as their wealth, sorry to say. A more organized form of banker also emerged during this period, such as the Rothschilds. And Bank of England was started in 1694, and they started regulating the Rothschilds of the world. The world was becoming a lot more commercial, and we saw New York being exchanged for the Spice Islands of Run in 1667. During this period, we did see improved human conditions, mainly through scientific achievements, such as microscope, intravenous medicine, vaccines for smallpox, anthrax, cholera, rabies, just to name a few. Despite these improvements, inequity remained within the society. And Karl Marx's 1848 Communist Manifesto just shaped the things to come in the 1900s. This period saw a never before seen, but soon to be eclipsed, explosion of human population from 600 million to 1.6 billion. This period ended with the beginning of the Industrial Revolution with coal and steam engines and telecommunication, which set the stage for what will later be known as the Great Acceleration. The interesting thing about these first three phases is, for investors, the only thing that mattered was returns. The next phase is an interesting one as well, 1900 onwards, as we move into this period, which is called the Great Acceleration, or the start of the Anthropocene period. We see a period where human population, wealth democratization, energy consumption, use, abuse of natural resources, social consciousness, global awareness, and material technological advancements enter a period unlike any other. This was the golden period of wealth creation for industrialists, companies, and even middle class. Thanks to the Industrial Revolution, which started in 1800s, railways, emerging market stocks and bonds, plus 2 world wars, governments in the early 1900s promoted and almost forced private investments in capital markets. And we saw democratization of wealth happen on a massive scale. Further growth in investors came through the creation of pension plans and the investment vehicles of the 1940s. Actually, 1950s, 60s, and 70s cemented shareholder and financial capital primacy to the exclusion of all other forms of capital. At an investor level, Nobel laureates such as Harry Markowitz, with his modern portfolio theory, chained investors to the concept of risk around financial benchmarks, again to the exclusion of other forms of capital. To this day, we still blindly rely, hug, and beat benchmarks and want more to justify our sustainable investing. From an environmental perspective, during this period, fossil fuels, which were dominated by coal from 1890s, was overtaken by oil in 1960s, with oil, interestingly, also approaching its limit in terms of contribution within 70 years by 2030. Climate as a global issue only saw its first discussion post-World War II, and even then was stopped in its tracks in 1965 when developing economies refused to take part in climate and environmental discussions. Environmental issues increasingly got attention on a global scale, but the response were mixed, with many countries still not providing the bare minimum that was required. Social consciousness has been evolving in this period, but with increase in inequality preventing a true global order. Improvement in social contracts have seen an erratic roller coaster ride during this period, especially as capitalism faced off all other until today. Human capital has seen substantial improvements in lifespan, but on an individualistic level, the gaps in human development remain stark to this day. So this is where we are now. Up until now, financial capital has been created mostly at the expense of other forms of capital. Up until now, risk and return on financial capital has been the only focus on investors. And up until now, human, social, and environmental capitals have been treated as expenses, not assets, with associated externalities outsourced by companies to the benefit of shareholders. Some argue that the world's population has stopped growing, and by 2050, we will peak at 9 billion. Now, while this could be correct, the fact remains that now there are only 2 to 3 billion people with middle income status. Another 2 to 3 billion are waiting to graduate to this level. If the last 3 billion have used up so much of human, social, and environmental capital, what will be required for the next 3? It is fair to say that as we progress past now, there is a shortage of pressure on human, social, and environmental capital. So to continue, so if traditional investing with its single-minded focus on financial capital continues the way it is, it will come at a great cost to firms' employees, society, the environment, and even to shareholders. In the past centuries, financial capital was scarce and therefore required focus. Now all other forms of capital due attention, and that is why stakeholders are speaking up. And that's why stakeholder capitalism, we believe, is taking over. Now, stakeholder capitalism is not at the expense of shareholders. If anything, companies and shareholders can only achieve sustained financial returns if they respect all other shareholders and build business models that ensure progress on human, social, and environmental capital. So Panvesting, we believe, which is the focus on all forms of capital, is a natural evolution in investing, where pan meaning all in Greek, forms of capital are focused upon so as to manage risk, return, and progress for all stakeholders, including shareholders. So with that, you could say this history, or this lesson in history, is something that we've taken to heart at Panarchy Partners, and we do believe in this move towards stakeholder capitalism and Panvesting as a solution. But to put it in the context of the modern day of investors and asset owners and capital owners, I think we have to sort of look at what is the problem. What is actually the problem other than the feel-good factor of stakeholder capitalism? So this move from shareholder capitalism to stakeholder capitalism, let's start with shareholder capitalism. Shareholders, their focus has been on financial capital and risks around their financial capital. But in the last many centuries, that has happened to their benefit because they've been able to outsource many externalities, especially when it comes to the environment, where carbon, waste, water use, and various other forms of environmental externalities have been outsourced. It's in the sake of human capital, things such as training, unemployment and health benefits, recruitment, all of this has also been outsourced to governments. And finally, social capital. Suppliers and distributors have generally been squeezed for profit margins, again, for the benefit of shareholders. Now, this is what has sort of defined shareholder capitalism. And in our training as investors, we've used a lot of these factors when we've done financial analysis on companies and their future returns on financial capital. As we move towards stakeholder capitalism, and this is for owners as much as it is for investors who are agents of these owners, we are stakeholders. And even as shareholders, we should consider ourselves part of the broader stakeholder community. There are more stakeholders, last I checked, of every single company than there are shareholders. And these stakeholders have got a louder voice than ever before. these stakeholders, again, including shareholders within that, they are now looking for return, progress, and risk on all forms of capital, as opposed to just risk and return on financial capital. Another thing to highlight, and this is more so for companies, this is where the dilemma or the problem arises for investors, is that risks and costs of internalizing externalities, which in the past were outsourced, is going to become a big part of our investing process, analysis, and decision-making. So in the case of environment, we are entering a decarbonizing world where carbon taxes are going to become a reality. Waste management cost and water usage is going to become relevant issues as well. On the human capital side, development, training, and again, unemployment benefits is going to be playing a part and having to be taken on board. And we are already seeing that with the current COVID crisis and how certain companies with the stakeholder focus are actually taking care of their human capital. Last but not least, the society and the social license to operate and how that is incorporated through community investments, through sustainability of the distributed suppliers and partners is becoming critical again. And if we look at what some of the companies are doing in this COVID crisis is just exemplifying this move, at least from a corporation's perspective, towards stakeholder capitalism. So this is the problem that in a bigger picture one has as we move towards capitalism, stakeholder capitalism. Now, looking at this problem in the same framework that I described previously, we have the two axes, financial returns on one axis and the progress on human, social, and environmental capital on the y-axis. And generally, when we look at balancing these financial capital versus the other forms of capital, investors have thought, and there's a perception that it lies somewhere along this line. So you have a uranium mine, which if bought at the right time in the cycle, can deliver you good financial returns, but the progress on human, social, environmental capital is very low. On the other hand, if you invest or donate money to WWF, you have very good progress on human, social, environmental capital, but your financial returns are negative because it's a donation. Most people believe that, and most investors believe that deploying money with these four forms of capital to be balanced sits on this line here, where you have impact investing, again, low returns, but high progress on human, social, environmental capital, moving to renewables, thematics. And as we come down this towards where most investments see, people have a perception that you have a financial return at the expense of progress on human, social, environmental capital. The question is, how do we get here? How do we get to a space where not only do we deliver financial capital returns, but also deliver progress on human, social, environmental capital? As investors, as capital owners, as asset owners, this is where we want to get to. And that is where we believe that investing has to move away from one focus on financial capital to all other forms of capital. And that is done through panvesting. Now, what is panvesting? In a simplistic sense, panvesting is the act, it is to be vested in the four forms of capital that a company needs, nurture, deploys, and use to grow. The four forms of capital being human, social, environmental, and financial capital. It only leads that a panvestor, therefore, is someone who is a person or organization that focuses on these four forms of capital with the expectation of achieving returns and progress on all forms of capital. Now, at Panarchy Partner, and in the interest of time, I'll quickly show you how we have adopted our form of panvesting into a solution. So we believe to generate respectable returns and progress on all forms of capital, one needs to start with good governance. Without a well-structured board that is independent, involved, and makes the executive team accountable, one cannot expect good financial returns, let alone progress on other forms of capital. Robust governance should be accompanied with stakeholder engagement. Companies that have not canvassed various stakeholders are not respectful of the risks that lay hidden amongst their stakeholders' concern. Governance and stakeholder engagement show us respect, the first building block of our philosophy. The other side of this same coin is what we call purpose. We have found that companies that have genuinely identified their stakeholders' concerns also find their purpose. Respect and purpose are a necessary, but not a sufficient precondition for sustainable returns. The next element is companies need to identify material issues on all forms of capital which is financial, environmental, social, and human. They need to target these with SMART targets. And what we mean by SMART are specific, measurable, attainable, relevant, and time sensitive. And they need to be incorporated within the business models, whilst also respecting the financial sustainability of the firm. Firms need to then deliver on these targets, and companies can only do that through innovation and sustain them through flexibility in their organizational structure. And this is what something that even Esther in our previous presentation touched upon. This targeting of material issues with SMART targets and then delivering through innovation is what makes companies resilient, which is the second building block in Panvesting. At Panarchy Partners, we believe that it is the incremental improvement, not an absolute level, but an incremental improvement in terms of respect and resilience that leads to sustained financial returns, as it is constantly reducing the risk and also increasing value in all other forms of capital. And that's how you get your financial returns. And this is what Panvesting is: sustainable returns and progress on all forms of capital. To finish, capitalism, as we have grown up with and studied, is changing. And with that comes the challenge for investors. As we have seen over time, wealth creation has also evolved, with investors moving from return-only focus to return and risk. And now a lot of them are moving towards return, risk, and progress. So with that, I end my presentation and happy to have any questions.
Thank you, Munib. That was very educational, something close to my heart, because I really passionate about sustainability too, especially when it's in all forms. So I'm going to ask you a few questions from the floor. So this is a two-part question. Someone asked, when do you think monopoly finance capital has got the upper hand? And do you think that finance capital is inimical to innovation and industrial production?
So financial capital, when I was growing up in the 1980s, and when all the economics 101 was being created for when I went into the university in the early 1990s, at that time, financial capital, if you measured all the value of assets, financial assets around the world, they were 1 times global GDP. You fast forward to 2017, the value of financial capital, according to Morgan Stanley in 2017, was 3.5 times global GDP. So I think it's taken a lot, these 30, 40 years, at least since, 30 years since I've been around, for financial capital to become so massive and so impactful and monopolistic in some ways over the other forms of capital. That's the first part, I would say. The second one was, sorry, if you don't mind repeating.
Do you think that finance capital is detrimental to innovation and industrial production?
No, I think financial capital has to be deployed, and without financial capital, we wouldn't be where we are now. There's no doubt about it. Now, this is not the forum for us to go into the nitty-gritty of financial capital allocation, how it should be done and how it shouldn't be done. But let's face it, without these 4 forms of capital, including financial capital, no organization will be able to sustain itself, whether it be even for day-to-day survival, let alone for innovation and growth, and to make an impact. So even for those people who want impact at the forefront of any organization's, you could say, outcomes, without the financial survivability, you cannot sustain your impact, let alone grow and innovate.
Okay, we have a couple more minutes. We can do 1 or 2 more questions. So someone asked, what your proposition sounds theoretical. Can you offer some examples of how these have worked?
Yeah.
So you can offer some examples, yeah.
Yeah, so for us, I'll give you some examples. Prime examples of companies that have incorporated stakeholders' concerns, which is around human, social, and environmental capital, into their business models, are companies such as, you would say, Unilever, such as Reckitt Benckiser, such as Danone or SAP, Microsoft. Now, these guys, what they have done is, after having Canvas, and all of these guys have actually done their first stakeholder engagement in the early 2000s, they identified the material issues and risks around it for the other forms of capital other than financial. And then they put in targets to address those issues, while the CFOs also made sure that how that impacted their financial returns and margins also was measured. And a prime example, 2 cases at point would be Unilever versus Kraft Heinz. Kraft Heinz had, when it made a bid for Unilever in 2017, it had operating margins of in the mid to early 20s. If you looked at Unilever then, their operating margins were at about 16, 17, heading towards 18 to 20% as they have always guided. Now, Kraft Heinz always wanted Unilever to have such high margins, and the only reason Kraft Heinz could sustain those margins is they did not care about their stakeholders and they were not innovating and flexible. And guess what happened? 2 years later, that all fell apart. So deploying margins as investments, keeping your stakeholders on the way to improving your margins and not being greedy. In other words, optimizing your profits, not maximizing your profits with all stakeholders in mind is a sure shot way to sustain and be resilient through cycles.
All right, that's the last question of the day. Our time is up. So thank you, Munib, for your presentation. That was really interesting and inspiring. I'm going to now pass our time back to our host, Amanda.